Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Omar Aguilar, Schwab Asset Management CEO and CIO, writing, economic uncertainty is still high, so think long term. Stay disciplined, stay invested, and stay diversified. No need to be a hero. Omar joins us now for more. Omar, welcome to the program, sir. Let's talk about that economic uncertainty. How are you getting a clean read on the economy in America?
Well, you know, the big part of the trade-offs right now between inflation, unemployment, economic deceleration, and overall, you know, the path that we're seem to be going here, it is unclear how the consumers are actually driving the majority of economic growth. We have seen so far this K-shaped economy where the top end of earners continue to drive GDP growth, and the wealth effect coming from equity markets, coming from housing, coming from anything else, seem to be very consistently supporting economic growth, where the other part of the economy, the lower income consumers, seems to be, suffering from, the pressures on inflation, the increasing in prices. So that sort of K-shaped economy seems to be the one driving a lot of this economic uncertainty, and the trend seems to pointing out towards deceleration.
No need to be a hero. I keep thinking about that. The implication is focus on quality, as you say. What does quality mean? How is the idea of quality changing, given the backdrop potentially of inflation, the backdrop given of slow growth with this sort of persistent price pressure?
Yeah, the big part here, Lisa, is that we have these forces that are sort of going at each other. Inflation seems to be very sticky and stubborn. We've seen the economic value and the unemployment being in these no hired, no fired situation. We see wage growth still ticking up a little bit, putting pressure on inflation, and something at some point is probably have to give up. What that means is that in certain way that deceleration supports stronger balance sheets, supports discipline in management, supports capital expenditures, supports areas that define the quality of a company, where corporate America is using all the potential tailwinds coming from the economy to be able to manage their business in a way that is consistent with what the consumers expect, but at the same time have the potential for a sustainable, and that's the definition of quality, sustainable earnings growth. When you put that into context, that's where we refer us to say, look for those companies that allows you to stay invested, that continues to have strengthened the balance sheets, and that will be stronger even if the economy decelerates. So that's a big part of what we have on both, on fixed income as well as on equities.
Can you find more quality, more reliability in corporations versus governments right now?
Corporations have been very disciplined over the entire period since the pandemic. And if you actually look at a big part of the driver, you can see it in the credit market. The credit spreads have been incredibly tight. And most importantly, not only the level, but if you actually see the level of volatility of the credit market, is actually very surprising to just see that even though we have seen all kinds of uncertainty coming from headlines and everything else, we've seen that incredibly, well positioned for high quality companies where leverage has not been high. Obviously there are companies that have done it and that have been in the process of potentially, disappointing in terms of their future. But overall, that quality is being well reflected in credit. When you think about governments, deficits have ballooned, and you actually see what's going on in the UK, what's going on in the United States. Clearly, a little bit of that defense spending as well of capital expenditures that has been positive for the economy. It obviously puts a little bit more pressure pressure on the long part of the fixed income curve. And you can actually see just that level of volatility that we see in the long end of the yield curve.
This is why it's so challenging when you look at what the Supreme Court has in front of them. This could actually impact potentially what bonds do, given the fact that trillions of dollars coming to the United States from tariffs is supposed to be depleting the deficit. Omar, if we were to see the Supreme Court strike down what is going on with IEEPA and the President of the United States, what would that mean for the bond market?
Well, first of all, the things that are actually very clear, the trend for the yield curve is to steeper. I think we are convinced, in our research that, overall the uncertainty in the long end of the yield curve, will continue. We see that even just in the last 24 hours, where we've seen volatility on the 30-year, yield on bonds, being, quite dramatic. And a lot of that is because inflation expectations, but two, is also, what will be the long-term, views in terms of the deficit regarding, to the setup that may happen with the uncertainty of tariffs. It's kind of interesting to see that uncertainty of tariffs, started by affecting sort of the short part of the yield curve and now has been pushed towards the long end of the curve precisely for what you just described, which is a big part of why, the middle of the curve seems to be the one that has been the most stable. And even with the yield curve, starts to steepen, you can actually still see some stability in that area.
Stay with us. More Bloomberg surveillance coming up after this. Joining us now is Monica Guerra of Morgan Stanley to discuss some of this. Just how much deficit risk is in play with this court decision?
A significant amount. The OBVA added, $4.5 trillion to the deficit in the last, estimate that they gave when they modeled things out. When we're thinking about this revenue, we're looking at about, $20 billion plus a month. That's a huge shift. It was $5 billion prior monthly. So again, there's a lot at risk here when you're looking at that $2 to $3 trillion range of revenue that they're expecting. That's enough to really offset a lot of those budget hawk concerns, right? Especially around the deficit.
And this is one reason why markets haven't freaked out at some of the budget deficit concerns. There is a question of why there hasn't been more of a response in the long end of the yield curve to this court ruling. And some people argue, well, that revenue will keep coming in regardless, one way or another. Do you agree with that?
Yeah, so it's our base case that even if the Supreme Court does rule against Trump, that, if there's a will, there's a way. And we've seen that not just through them exploring other options of levying tariffs through different federal agencies, but also through different, sections of tariff law. Section 232, Section 301. There's a ton. There's a whole list. We recently published a report where we really get into the details on each one, the timeframes, how it works. And while some are limited, they can layer these, and there are some that are more long term. So there are options out there, and I think that markets understand that, and that they're trying to look through any volatility around the Supreme Court.
The direction of travel is clear. They're going to find a way to increase tariffs, even if the Supreme Court does strike this down. But do you think the Supreme Court, is that your base case? Will they uphold IEEPA, or will they strike it down?
I'm not the expert on the Supreme Court, but what I can say is I think that there is a strong likelihood that they will rule in favor of the president. And then if not, right, it's just how do we get there? And we also have to remember that right now the tariffs are still in place. So it's not like they've completely rolled off. We're still collecting revenues, right, as we go along. And even if we do end up with a patchwork and say you get 10 billion a month, that's still double what we were receiving before, and that is a help towards that deficit.
How messy is that unwind going to be, though, if they were going to have to potentially give back some of those funds?
It would be messy. If you're thinking about even negotiations with the EU, they're trying to proceed as business as usual, but they're being very cognizant that some of these things may have to be unwound if things are unstable. Now, what's interesting is that when other foreign entities have been asked in the recent days, how are you approaching this? They're still continuing negotiations as if things are in play. And so we have to, keep that in mind, that there's a strong belief that tariffs are coming one way or the other.
So this sounds very technical, but I have been getting a little bit overly technical recently. The stay from the court only goes till October 14th to keep these tariffs on. The Supreme Court has to decide to take this up and then rule on it, and that stay expires. what happens then? I mean, can't companies go to the government and say, can you give me my money back because I paid you a couple $2 billion?
It's unclear to me if that's retroactive, right? So if you're already paying, I'm not sure about the logistics there. I doubt it is. I'm sure the money that the government has collected will stay in the Treasury where it's safe and sound. I would say the biggest concern for us from a markets lens, right, is that if there's more volatility here, especially for businesses come October, are people going to hold cash on the sidelines? Are they going to continue to wait on, say, CapEx expenditures? What is the longer term economic impact, right, from that volatility?
Stay with us. More Bloomberg surveillance coming up after this. Turn to the economy and to retailers. Macy's surging 20% in Wednesday's trading following an upbeat forecast on the consumer. The retail team at Goldman Sachs writing, quote, while there continues to be concerns around spending behavior, we remain cautiously optimistic going into 2026. Joining us now from the Goldman Sachs Global Retailing Conference is Goldman's lead apparel analyst, Brooke Roach. Brooke, welcome to the program. Let's just talk about this. So, the retailers are talking up a better story. The economic data is not so great at the moment. What's the call from you and the team?
Good morning, and thank you. It's great to be with you this morning from the Goldman Sachs Global Retailing Conference. This is our 32nd annual conference, and we're with nearly 80 companies talking about strategy and what's happening in the state of retail. Bottom line is that the consumer remains resilient.
This is what we're hearing from a lot of different companies. And yesterday I was there and I was speaking with one CEO who said it's sort of like a flat surface, a hard surface. Under the hood, there's a lot going on and a lot of molecules that are kind of battling each other, but it all comes together to kind of a flat surface. What are people looking at that could potentially break it to the upside, this sort of stealthy bull case that we keep hearing about?
That's a very good question. I think overall, as we put together all of the various inputs of what might be driving consumer discretionary demand on a go-forward basis, we see a better outlook into 2026, with discretionary cash flow modestly stronger across income quintiles and with some real opportunities for consumers to engage with great product and great retailers. What we're seeing overall is that trends have been better throughout the back-to-school season. And this strong back-to-school season start is much better than expected. And I think there is a view from many retailers that there is some cautious optimism that hopefully this will continue. But I think retailers are very cognizant that there is a tougher comp ahead and that there is some uncertainty on what the pricing backdrop might mean and what that might mean for consumer engagement from a demand perspective. The good news is that we haven't yet seen price elasticity of demand, and back to school has been strong. So what could break it? I think there's a lot of questions on what could be the case for consumers in terms of their mood or what might be happening, but we believe that the outlook is fairly robust.
What you just said there is actually really important, the idea that a lot of these retailers are increasing prices and people are still buying. In other words, they still have the power to increase prices and it's not destructing demand. And you're seeing that pretty much across the board. They're able to raise prices in select ways. Do they have a sense of whether this is coming from wealthy individuals, whether this is coming particularly from more luxury sectors, or whether this is across the board through all the tiers of different income levels?
I think at this point, retailers are trying to do their best to protect the consumer and to protect their businesses, but they are seeing some cost increases overall. At this juncture, we've only seen modest price increases across the board based on what retailers are telling us, but there is some question about what that price might look like into the back half of the year. As we think about that, the change so far, given that it has been modest and it hasn't been broad-based across the board as far as what retailers are saying right now, consumers have been able to absorb these price increases. They do have higher discretionary cash flow in their, they do have a stronger wallet right now. And so far, it does appear that many retailers are looking to try to do it in a way that won't hurt the consumer, whether that is a mix shift into different types of products or categories or otherwise.
Brooke, before you go, can we lend some thought to the idea that maybe the C-suite, I think, is struggling with this cultural moment in America as well? I'd love your thoughts on this and what you're hearing from from management teams. I'm thinking more recently of Cracker Barrel almost blowing itself up, American Eagle leaning into controversy, and it benefits them. The stock is up nicely in the pre-market so far this morning. What's your understanding of how the C-suite is wrestling with this moment?
You know, I don't know about your specific examples that you gave, but what I would say is that retailers are focused on engaging with their core consumer. They're investing more in marketing. They're looking to try and create better products that will drive strong consumer demand regardless of what the macro backdrop looks like. And we're seeing more and more retailers lean into that. And we heard that a lot yesterday with various comments about marketing, consumer engagement, and great new product.
Stay with us. More Bloomberg surveillance coming up after this. Subadra Rajappa of SocGen remaining slightly cautious, writing this. Well, the hope is for lower policy rates to stimulate the mortgage market. That could backfire. We could see a repeat of last September when a 50 basis point rate cut resulted in higher long-end yields. Subadra joins us now for more. Subadra, good morning.
Good morning.
Going to pick up on the line of questioning that we finished the last interview. Is this Federal Reserve cutting into strength?
It feels like it, because if you look at a lot of the data that's come in, economic surprises have been to the positive side. You know, the growth momentum into the second quarter is also on the positive side. Inflation is high and sticky. The job market, as Mike McKee was pointing out, there's no hirings, there's no firings. It's in a state of stasis. So to me, it feels like that, plus all of the fiscal stimulus that could potentially come down the pike, could be something that could move the markets higher. So it feels to me like some of these cuts that are priced into the market are more preemptive than really something that's warranted.
Is this something that's tradable now, or is this just sort of warning shot ahead of what could be a tumultuous couple of months?
I think so. I mean, the market's pricing in nearly 6 cuts between now and the end of next year. The market's, people are looking at, a cut and maybe 3 cuts this year. To me, it feels like if they cut sooner and more aggressively, they won't be able to cut as much next year. So the neutral rate is going to have to be a lot higher, given the fact that inflation is still high and sticky, and the risk is that you could see a reacceleration of inflationary pressures. So the market, to me, feels like it's overpricing cuts between now and the end of next year.
Even with the political impetus, right? I mean, how do you sort of overlay any kind of political interference with this, given that right now this is a Fed that has a dovish bias and might have an even more dovish bias by the time we get around to 2026?
So that's the part that's tricky, and I think that that's part of the reason why the market's pricing in 6 cuts by the end of next year. So the market's really looking at what the Fed could do as opposed to what the Fed should do. So to me, it's very hard to really kind of separate the two aspects. One is if we have a very dovish committee next year, that could really change the dynamics in the market. But over the long run, that to me leads to Fed credibility. A lot of times we look at the market and say that, the bond market is very complacent right now. Volatility is very, very low. But you could see a pretty significant sell-off in bond yields in a very short amount of time if there is a crisis of confidence.
But there isn't right now. How much are you going to be watching this Stephen Miron Senate confirmation hearing, just to really, as Terry Haynes put it, read the body language of the Senate, which at the end of the day, the purview of the Fed does belong to Congress?
Yeah, I mean, it is important. We will be paying attention to what he's saying. But it's really a committee decision as of now. It really depends on what the composition of the committee is going to be next year, who President Trump nominates to be the next Fed chair. So again, there's a lot of uncertainty, but there's a lot of complacency, I think, in the bond markets. Just going back into the last, few years, we've seen many episodes when bond yields have risen sharply. We saw 100, 150 basis points of bond yields rise after August of 2023, when the Treasury issuance, coupon issuance sizes changed. We saw a pretty decent sell-off in bonds even last year when the Fed cut rates by 50 basis points. So, to me, it feels like there's just that feeling that everything is going to be status quo when there's just a lot of uncertainty coming down the pike, whether it be Fed independence, whether it be the trajectory for debt and deficits, not just in the U.S., but also globally, and other kind of, extraneous factors like tariffs and that working through the legal system.
I think you build an incredible case, but what's been surprising for me is just how stable the Treasury market actually has been.
Yeah.
Yes, we've had steepening in America, like we've had steepening in Europe, but this steepening has been completely different. It's been led by the front end. 10s and 30s have been really resilient relative to some of the chaos in France, some of the chaos in the UK. What's supporting the Treasury market right now? Maybe that's an interesting question to ask. What is supporting this? What is keeping 10s at 420, 30s away from 5%?
So I think that when you look at the composition of where people can invest, I mean, clearly the front end is pegged to Fed expectations. The market is pricing in, as I said, a lot of cuts over the next year and a half. And then when that trade's maxed out, investors kind of move on to the belly of the curve. And the belly is really where you've seen a lot of the flows. I mean, the 2-5 curve actually inverted a few times. You're seeing a lot of demand for the 5 and 10-year part of the yield curve. And investors, broadly speaking, are concerned about putting money beyond that 10-year sector because there's a lot of volatility in the very long end, not just from the debt and deficit trajectory for the U.S., but also what's happening globally. You're looking at, the picture in Japan or, the political, unrest in France. That all argues for higher long-end yields. So really the center of gravity for the Treasury market seems to be the belly of the curve.
So last year, they dropped rates 100 basis points. Yields rose at the long end by 100 basis points. What are you actually looking for into year end? What kind of number? To me, it feels like the 10-year yield is still going to stay between 4 and 4.5%. Yes, to me, the risk is that we might actually start drifting towards 4.5% if the market starts to get concerned about kind of the inflationary, impact of tariffs that feeding through, or if there's any sort of concern over Fed credibility. But, the different sectors of the yield curve are still going to remain range-bound. Where I'm really concerned about yields getting unhinged is in the very long end. I think 30-year yields could very easily get to 525. I mean, we saw a lot of volatility in just this week in the 30-year. So it's very conceivable that you start seeing, that sort of concern play out in the very long end of the yield curve. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.